Today, we're analyzing a company that the reports are calling, and I love this label, the ultimate cash flow machine.
It's a great name for it.
We're going deep into the financial architecture of Broadcom, that's ticker AVGO, specifically to understand the pretty dramatic implications of their recent 10% dividend increase.
And that's the mission, precisely. We're looking at the sources to distill this story of balance. I mean, yes, the growth is absolutely staggering. You see revenue up 28% year over year.
Huge numbers.
But the real deep dive here isn't just about the expansion story. It's about safety. It's about how Broadcom has somehow engineered a business that captures all this high-octane growth from the AI boom, while also offering the kind of rock-solid rising income you'd normally expect from, like a utility company. That dividend hike is the clearest signpost we have for that strategy.
And it's the headline that kicked this whole thing off, the announcement. Broadcom raising its quarterly dividend by a full 10%. That pushes the payout to 65 cents per share.
A huge jump.
This kind of financial discipline, this commitment to growing the cash return right alongside the market expansion, that seems to be the core narrative.
It is. Okay, so let's get into it. The starting line for any discussion on income investing has to be this. You simply don't announce a 10% dividend hike unless you have just complete, unimpeachable confidence in your cash generation.
Especially not in this market, right?
Exactly, especially not now with capital costs still elevated. It's a signal. It tells you management sees this cash return not as some kind of luxury, but as a core function of the whole business model.
Okay, so if that confidence is the engine, what does the financial power behind it actually look like? Let's put some hard numbers on it.
We need to focus on one metric, really, above all others, free cash flow, FCF. Yeah. And just for a quick refresher, think of FCF as the actual cash that hits the company's bank account after all the bills are paid, all materials are bought, and all the necessary investments are made. It's the true, unencumbered profit.
The money they can actually use for whatever they want.
Precisely. And in Broadcom's case, that number is, well, it's enormous.
How enormous are we talking?
Monumental. In their most recent quarter alone, Broadcom generated $7.47 billion in free cash flow.
Wow. One quarter.
One quarter. And look, that number is so big it can almost lose its meaning. But here's the crucial insight from the analysis. Context is everything.
So let's give it that context. That kind of cash generation must mean they're incredibly efficient.
They are. What really stands out to the analysts is the FCF margin. That's $7.47 billion. It represents a staggering 41% of their total revenue.
41%.
41% flows straight into cash. 41 cents of every single dollar they earn is immediately ready to be deployed. For a company in a highly technical manufacturing sector, that is nearly unheard of. It just cements their status as a pure capital return engine.
That margin in a single number, that explains everything. That explains the confidence to raise the dividend by 10%.
Absolutely.
Okay, so let's move from the engine room to the output, the dividend itself. For the long-term investor who's really focused on income, the new payout is 65 cents per share per quarter. That currently translates to a yield of about 0.76%.
And that's where you might, initially pause. A critical reader looks at that and says, wait, 0.76%. Why bother when I can get 4 or 5% from a treasury bond?
Is the elephant in the room.
It is. But this is where you have to understand the long-term compounding story. For an income growth investor, that current yield is just an appetizer. You're investing in the trajectory.
In the growth of the payout itself.
Exactly. A 10% annual hike, when you combine it with that 41% FCF margin, means that your income stream is accelerating and deepening incredibly fast.
That said, acceleration can often imply risk. We've talked about this sleep well at night stock narrative, but let's introduce some friction, which the sources themselves do address.
Okay.
Broadcom acquired VMware, a massive deal, and it required taking on massive debt. Do the reports address the risk that, high interest rates plus that debt could jeopardize that beautiful FCF margin?
That's the essential question, and it's really the main counter-argument that the bull case has to neutralize. And the answer lies right back in that $7.47 billion FCF figure.
So the cash flow itself is the defense?
It is. Even with that debt load, the cash flow is so robust that it easily services the debt payments and it covers the dividend. The safety analysis shows the payout is practically bulletproof. They have billions left over after paying shareholders and the debt.
And what do they do with that leftover cash?
They fund absolutely crucial activities. Primarily, paying down the principal on that debt, and critically pouring money back into R&D to maintain their tech lead.
So the sources are suggesting the cash flow isn't just for the dividend. It's the protective moat that makes the debt manageable and lets them invest aggressively.
That's it, exactly. It completely changes the risk profile. You get this comprehensive exposure to the most exciting tech shift of the decade, the AI boom, but you don't get the terrifying, the existential volatility that just slams those smaller, pure play AI chip stocks.
Right.
Broadcom's structure gives you a foundational layer of recurring cash flow safety.
Okay, so here's where it gets really interesting for me. We've established the massive cash generation, but what operational drivers are actually feeding this cash flow fire hose? What's delivering that 41% margin?
The sources point to two major pillars. You've got one that's super high growth and one that's a high margin stabilizer.
Let's start with the exciting one.
Let's do it. The spectacular growth component, driver number one, is the undeniable gravitational pull of the AI revolution. And this isn't just some, theoretical market hype. It's measurable industrial scale demand. Broadcom's AI revenue surged an astounding 74% year over year.
74%, that's a huge number.
Yeah.
But it begs the question, what is Broadcom actually doing in AI that's different from, say, NVIDIA, who dominates all the headlines?
Yeah.
Are they just selling commodity chips?
Quite the opposite, actually. They're focused on custom silicon. They create what are called application-specific integrated circuits, or ASICs.
ASICs.
So if NVIDIA sells the high-performance, sort of off-the-rack gear, Broadcom is making the bespoke, custom-tailored suit for data centers. These are custom chips designed specifically for the world's biggest internet companies, the hyperscalers.
We're talking about Google, Meta, those guys.
We are talking about companies like Google and Meta specifically.
And why would a company like Google want a bespoke chip instead of just buying a super powerful GPU?
It really boils down to efficiency and optimization at an unbelievable scale. I mean, these hyperscalers are building out infrastructure that costs billions. Every fraction of energy saved, every millisecond of latency reduced, that translates into enormous savings and a real competitive advantage.
Okay, so it's about fine-tuning.
It is. Broadcom's ASICs are tailored precisely to Google's specific machine learning workloads or Meta's data architecture. It lets them max out performance while optimizing energy use, which is critical when you have millions of chips running 24/7. That makes them incredibly steady, high value, and very, very sticky customers.
And that covers the explosive growth. Now let's talk about the other half of the story, the high margin stabilizer, the VMware integration. Why was this acquisition so, genius from a financial architecture perspective?
The VMware acquisition was a conscious structural change. It was designed to eliminate the historical weakness of the whole semiconductor industry.
The boom and bust cycle.
Exactly, the boom and bust cycle. Traditionally, chip sales are lumpy. Companies buy in massive waves, and then procurement just slows to a crawl. Broadcom realized that to support a consistent rising dividend, they needed reliable, recurring revenue.
And that's where the software comes in.
That's where the software comes in.
Yeah.
VMware provides these critical virtualization tools, but more importantly, it operates on a high-margin, recurring software subscription model. Once a big company integrates VMware, they're pretty much locked in. They pay those subscription fees continuously.
So if there's a sudden slowdown in hardware orders, say Google pauses buying chips for 6 months,
The subscription money from VMware just keeps rolling in consistently.
it sounds like they're consciously trying to shift the business model. What percentage of their revenue mix is now protected by that subscription layer?
The sources really emphasize that this integration fundamentally shifts the balance toward high-margin software. This recurring, predictable software revenue provides a baseline of cash flow stability that really few other chip makers can claim.
And that predictability must be what lets analysts project so far out.
It's everything. It guarantees that the baseline FCF stays robust, even if hardware sales fluctuate. This is what lets them project such optimistic forward momentum.
And that momentum is substantial. What are the projections looking like, fueled by this new, stable model?
Analysts are projecting staggering scale. Consensus estimates show the full year FY 2026 revenue hitting $96 billion.
Wow. Almost $100 billion.
Nearly $100 billion in revenue. That kind of visibility and projected scale just reinforces every positive claim about their capital structure and the dividend sustainability we've been talking about.
Which brings us squarely to the immediate context, the opportunity for an investor right now. Because despite all these glowing numbers, the stock has cooled off a bit recently.
It has. If you look at the recent price action, the stock is consolidating around $343. It's a noticeable pullback from its recent highs, which were up around $414.
So the market's taking a breather.
I think the market has taken a brief pause to just fully digest the VMware integration and the debt that came with it.
So this cooling off, this dip, is actually being framed in the analysis as the opportunity for an income investor who might have missed that initial explosive run.
Precisely. For you, the income growth investor who wants to tap into this reliable cash flow stream, this consolidation is a golden chance to lock in a lower entry price. You get all the stability, all the growth potential we just analyzed, but you get it at a significant discount compared to just a few months ago.
Right before what could be the next leg up.
Potentially, yes.
And what are the analysts projecting for that next leg up? If we look purely at capital appreciation, what's the potential runway here, separate from the growing dividend?
Wall Street is very bullish on the near-term recovery. Banks like Goldman Sachs have set targets comfortably in the $450 plus range.
So from today's price, that's
Buying at the current level suggests a potential upside of approximately 30% on capital appreciation alone. And when you stack that potential 30% gain on top of a 10% annual dividend growth rate, well, it creates a deeply compelling risk-reward profile.
So let's put all these pieces together. The 41% FCF margin, the custom AI chips for Google and Meta, the software stabilization from VMware, and that big 10% dividend hike. What's the final verdict from the sources?
The bull case is that Broadcom is arguably the most disciplined capital allocator in Silicon Valley, period. They have successfully executed a strategy to generate cash efficiently, allocate it wisely to both growth and debt reduction, and generously reward shareholders.
So secure rising dividends.
Right. They've effectively blended the excitement and sheer magnitude of the AI boom with the certainty and reliability of mature, profitable subscription software.
That structural blending seems to make the final investment thesis pretty decisive.
It does.
If you want a piece of the AI revolution, but you also want to get paid growing cash while you wait for that next phase of growth, the sources overwhelmingly present AVGO as the top pick for 2026. This confluence of factors earns it the highest possible rating, a strong buy, conviction buy.
A conviction buy rooted in pure cash flow. And as you weigh that assessment, consider this final thought that really changes the company's long-term profile. The sources heavily credit the VMware integration for stabilizing the business. So how might adding that reliable, predictable subscription revenue that's totally decoupled from hardware cycles, how might that fundamentally change a chipmaker's entire approach to capital allocation and dividend policy over the next 5 years, making it permanently less cyclical and more stable than any of its traditional peers?
That stability could really redefine the blueprint for what a successful tech dividend stock looks like in the modern era.
It really could.